In high seas or calm, both opportunity and risk lurk just below the surface. Answers require in-depth analysis. Welcome to BlackFin Group's Shark Cage podcast.
Good day, folks, and welcome to the Shark Cage BlackFin's podcast series. My name is Keith Kemp, President and CEO at BlackFin. I'll be your host today. To start, I want to thank our sponsors who are BlackFin's preferred partners: Mortgage Flex, iEmergent, Cloud Virga, Take Three Technologies, Prudent AI, Finastra, Lending Pad, Argyle, and so many more. All really are doing some great things for the mortgage banking and lending industry. I got to tell you, if you don't know them, you need to get to know them. At least spend 30 minutes on the phone learning more about their products and services at all of our preferred partners. So, okay, with that, let's get started here. Today, I'm excited to have back in the Shark Cage one of BlackFin's preferred partners, Laird Nusili, the CEO of iEmergent. Welcome back, Laird. Good to see you and have you back.
Thank you. It's good to be here. It's good to see you too, Keith.
Cool. I think we'll have some fun here today because we're going to talk a little bit about data. And I think I know you know a thing or two about data. So, and more specifically, HMDA data. So this should be interesting. I know I'm going to learn something from our discussion. But just before we jump in, Laird, let me share with some of our newest listeners a little bit about your background so they can appreciate your expertise when it comes to the mortgage market data that we're going to talk about today. Um, Folks, for over 10 years, Laird was the CEO of Mortgage Market Smart, a lender analytics application, before also taking the reins as CEO of its parent company, iEmergent, in 2014. Throughout Laird's career, she has had a passion for housing equity, spent countless hours collaborating with housing affordability work groups, which has made her one of the industry's most sought after speakers on speaking about and how to serve diverse markets. She currently sits on two committees for the MBA's Convergence Columbus program, is a national partner with the MBA across its broader convergence initiatives. In a growing category of market intelligence providers, she has set iEmergent apart from others with its ability to provide lenders with a unique prism of historic, current, and future focused demographic, economic, housing, and competitor data at both the macro and micro level. I know it sounds like a mouthful, but man, you'd be amazed by the kind of data they can provide you so that you can do a better job of not only lending in more diverse markets, but also being able to increase sales. So, continuing in her father's opportunity driven message that has been foundational to iEmergent's advisory approach and their product development efforts, helping both lenders both do more loans with iEmergent data and ensure housing diversity is achieved. So, really, like I said, you got to get to know iEmergent. You got to spend some time digging into what they're doing. I'm aware of who the competitors are and what they're doing out there, but I tell you, it doesn't compete once you get into conversation and start talking about the data analytics and all that can be done and achieved for your lending firm, bank, credit union, based on this data to ensure fair lending and capture more deals. Laird, again, great to, I could probably just keep talking about you for the next hour, but we don't have that kind of time. So great to see you have your smile back in the room and love
Thank
the
you.
positive vibes and energy you're always giving. So welcome.
Thank you.
Well, so let me just jump in. During our last conversation, we really talked and spent a lot of time talking about the hidden housing market that's alive and kicking in the marginalized communities. I hear lenders always talking about needing more loans today. Well, they're out there. They just need the data and the market data to be able to analyze it. And I know every lender that works with you is just loving how you're helping them draw them to directly to more business. But today I want to talk about the fair lending HMDA data. You guys are fair lending HMDA data experts. So I'll ask more specifically, what are the as you look at that data, what are the 3 or 4 HMDA data trends you're seeing in the market today that are really eye-opening or mission critical? I know you've been writing about this topic, doing some other webinars about redlining. So can you share with our listeners what they need to understand about what today's HMDA data is telling us?
Sure. So when we look at the data this year, you kind of have to put the trends and what you're looking at into different categories, right? So if you look at it very, the overall picture, I don't think it's any surprise that the dollars and loans dropped significantly, both, from a purchase, refi, but also some interesting changes when you start looking at the home improvement and the other category.
Mm,
Specifically because I think, now that rates are lower, excuse me, rates are higher, don't we wish, right?
right.
Some of the, rather than get a cash out refi or refi, rate term refi, a lot of households are turning to home equity products, either for, or home improvement products, just as a good source of cash, because I guess it's a little bit better rate. So we saw a shift in the prevalence and importance of those other loan purposes this year.
Mm,
So, in the past, I wouldn't say that they were minuscule, but a much smaller part of the pie.
sure.
Um, so that's what we see kind of on that macro level. Um, if you start looking at it by, let's say, loan product, you can see that there's some interesting trends in that it's become a little bit from 22 to 2023. Government lending increased pretty significantly. So in 2022, for example, FHA was 10.8% of all loan units for purchase. That's jumped up to 14, almost 15% in 2023. So that's a big difference, a different type of product, different type of lender doing that. And what's interesting about that, and I'll tie that into the diverse markets in a little bit, but what's interesting about that, when you see that bump in FHA and government products, you can also see that when you're looking at market share ranks, the IMBs are dominating even in purchase in a way that we haven't seen before. I mean, like if you look at the top, let's say 30 lenders, um, I have my numbers here. Where it go? So if you look at the top 30 lenders, you don't not until number 9 do you see a bank, and that's Chase. But really,
Fascinating.
in that top 30, I have 6 depositories or the bank depositories, 1 credit union, Navy Federal, and the rest are IMBs. And so that's a shift, because in the past, especially with purchase, a lot of these big banks were dominating in that top 20. They're just not there. So I think a lot of that has to do with the type of product that's out there, and what's working. Now, to tie
Fascinating.
that product to diverse markets, for better or worse, if you look at some of the BIPOC households, Black households, they have a higher percent of their loans are actually government loans. And so that is one of the reasons why historically, sometimes, even though they don't have some of the same compliance drivers, right? IMBs can and sometimes do better with diverse households because they are just more comfortable with those other products. So so sort of on that big picture look, that's kind of where we're seeing that change in product purpose, and then that of course influences who the lenders are. Another interesting thing to call out was the difference in the overall shift in lender dynamics. So, and bear with me while I get these statistics right. In 2022, there were a total of 4,385 HMDA reporters. Well, that actually bumped up to 4,993 in 2023. Interestingly, though, IMBs, the count of IMBs dropped. Okay. So
Okay.
IMBs went from 21% of all lenders in terms of count to 17%. So, you would have thought that if there's that growth, that IMBs would, would be increasing, but actually they not just, this is even before some of these consolidations. So that's a pretty big drop. And then you see both credit unions and banks, picking up in terms of number count. When you look at the purchases and the way that, what share of that market do you have? 21% of the count is what IMBs are of actual numbers. They originate 62% of all purchases.
Wow.
So 21% of the lenders are doing 62% of the purchase with IMBs. And so even though there might be as many, they're doing more per enterprise than the credit unions or the banks.
Wow. If
yeah.
I'm reading between the lines there, Laird, part of what I'm hearing is IMBs are, does it come back to some of that freedom when you peel back the onion on those data points, that they have a little more freedom and they're not as constrained as a bank, which can be a little more conservative and certainly has dialed things back. And that's why the IMB still remains strong, because one, they're more agile, so they can adopt more product diversity, which is what I'm hearing, which can allow them to expand into other markets. And as a result, they can be a little more aggressive. Is that part of what the numbers are telling us?
I think so. I think, going back to sort of the way that IMBs do business, we work with a lot of credit unions, banks, and IMBs, and it's interesting because each one thinks the other has it better. It's actually kind of funny. It's like you're talking to banks, and I was like, it's not fair, or the IMBs, they don't have to deal with CRA. They don't have some of these different requirements. The IMBs are like, well, we don't get CRA credit, so that's not fair. We can't utilize CRA product and some of the benefits that come along with having CRA needs. And of course, fair lending applies to everybody. But I think one of the things that happens, it's kind of twofold. On one hand, credit unions are uniquely positioned because they're mission driven and do a good job, that they don't have as big of a market share, but they can do and are important lender types for BIPOC households and underserved LMIT, low to moderate income neighborhoods, and low to moderate income borrowers. On one hand, the banks do have the ability to portfolio their loans. So when you're looking at things like special purpose credit programs or certain down payment programs, and then even looking, as I look at these numbers, the rise of the home improvement, the HELOC, 5% of that business, home improvement, is IMBs. 10% of other are IMBs. So you can see that even though the IMBs have some product flexibility, they're more limited in others. But I think what it comes down to is the IMB mentality, that sourcing mentality, kind of hunters rather than, I think that's a lot of it. It's just that they're just more aggressive in terms of going out and finding opportunity and capturing it than banks, where, they have bank branches. It sometimes comes that they have more of it's going to come to me because we're serving mortgage as secondary to serving our depository households. Does that make sense?
Oh, it totally makes sense. I mean, the order takers versus the hunters. I mean, I think you just broke that down brilliantly. And I do know of a number of great originators, top 10 originators in the country, who feel like, I got to find the right IMB so I can be let free, because I'm a hunter and the bank just constrains me on, this front or that front. And so it does get frustrating. But then there's other people that I know that are just absolutely content being at a bank and in credit union, because they get the support that they need, and yet, they're mission driven themselves, and so it's a better cultural fit for them. So that's really interesting. I mean, you probably look at that about 10 different ways psychologically. So let's talk about that then. What is, I mean, those are eye-popping, trends. to really let that rest on your consciousness about, the purchase market and the IMBs, and then, versus the HELOCs and the banks and credit unions and their market share. Much more difficult for an IMB, right, to be able to diversify into the HELOC space. But even I think a little bit of that is slowing down right now, just based on the overall economic sentiment and of things in the overall macro economy. But when looking at that data, what has been your advice? I've always believed the data doesn't lie. So, when considering those trends, what's a lender to do, maybe to correct course or to be able to capitalize on that kind of data, from a strategy, from an operations, from a process technology standpoint? I mean, should credit unions and community banks or regional bank, should they be thinking about, how do I get into more of a hunter mentality so that we can appreciate that fee income? I mean, the banks thrive on that mortgage fee income. So what's your advice, on both camps, I guess, on the IMB side and then on the depositor side, with those lenders?
Well, I think this is one of the things that's exciting about talking about this is that this is that unique time where what you're being made to do is also good for you. It's like it's good medicine, right? Because there's a lot of hostility. I'm not going to use the word hostility. It can be frustrating and
Right.
challenging to navigate compliance, the in compliance environment. But if you follow what it's suggesting you do, let's say if we look for parity, and by parity I mean the same percent of loans and apps come through every year that are households. So if a market is 60% Black, parity would mean that 60% of applications, 60% of originations would be going to Black applicants or Black
Yeah.
households. There's not a market in this country where we have parity, to be honest. So that's its own issue.
Hmm.
But when you look at the way things are growing and you look at, for example, what I call the purchase loan penetration rate, and that's that increase over year over year, the percent of loans that are Asian, the percent of loans that are Black, percent of loans that are Hispanic. You go down that list, and that's increasing year over year. So when you are having a challenge to growth, it is actually a really, convenient problem to have when you have to lend to these diverse borrowers, but they are also your number one opportunity for growth. And
Wow.
so if you follow the rules, it should, if you do it right, and and I'll talk a little bit about, how you do that and stay profitable. But if you do that, it should lead you on the path to growth. And so I find that we work with a lot our biggest percentage of our clients are banks, all sizes, some of the top 10, some smaller ones that are maybe, lending at the most, maybe 50 million a year. So a wide range.
Sure.
Um, banks it's in their DNA to care about this because of compliance. And it may start as being a compliance concern, but they quickly become interested in it as a growth opportunity. Our big IMBs that we work with get that. The smaller IMBs, we have to work pretty hard to get them to listen, to care, because they don't have, CRA is not breathing down their back yet.
Yeah.
Obviously, fair lending's a real thing, but if they're in a smaller market, you can get away. I don't want to say get away with it, but you can maybe not make waves enough to cause, a redlining accusation, but you could still be not serving a big part of your, your community, and missing out on what that community has to offer to your origination, to your top end. So, so in a way, it's a best practice from a growth perspective to be doing the same things that you would be doing as a best practice for compliance.
Hmm.
Um, that's a good thing. Imagine if it were not like that. Imagine if being compliant went against growth. I mean, that's maybe how it has felt in the past. But now being compliant aligns you with growth. So I think that's a win-win from a lender perspective. And then you add in communities, and we've got that trifecta that I talk about, the win-win-win. We are all going in the same direction. We may quantify it differently, but it's the same direction. And that's an encouraging time to live in when that's the kind of outcome you can have.
That's brilliantly said. You're spot on. How can you argue with that? Where not only can we grow, but we can also increase our opportunity of fair lending and making sure that we're balanced as an organization. So I just kind of an aha moment for me. But in order to get to that, I think that's where it can be a little daunting for
Absolutely.
banks and credit unions to say, okay, I understand you have the data, but oh my gosh, I mean, to point me in the right direction to make sure that I can get the trifecta of the win-win-win, as you
Right.
mentioned. So, what are the tools? Those are the trends. Those are that's what lenders can do. Take your advice to say, change your paradigm. That's part of the advice that I hear you saying. You need a paradigm shift to think more globally about the opportunity, not feel like look at fair lending as an opportunity, not as a constraint.
Right.
And so that paradigm shift is the first thing that has to happen. The second thing has to happen is you've got to put together a strategy, is what I hear you saying, around how you're going to do the fair lending.
Right.
And the key component of that is going to be a tool that a lender is going to need to integrate so that they can better leverage, the insights to do more fair lending and get that trifecta win. So what are the tools or what are the things that lenders need to, if I've got the paradigm shift taking place, I'm starting to think about fair lending, how to capitalize on that as an opportunity. What are the tools and the strategies I need to implement to make this real? I mean, I can see somebody going, I see all that iEmergent has to offer, but man, that's a nice tool. But are there other tools? Are there other, how do they leverage a tool like an iEmergent to really be able to penetrate and put together a coherent strategy?
Well, I think it begins with making sure that in the tool, whether it's Market Smart or other tools, um, you need data that is past, present, and future. And I say that because, like, think about ourselves. We are our past, present, and future all the time, right? So who I am right now is influenced by who I was, where I came from, and it's also influenced how I
Thank
behave
God,
today.
right? For some.
Right, and how I behave today is also influenced by what I'm looking for the future, right? So markets are the same way. So bringing past data, current data, dynamic current data, and importantly, and this is where I think we're a little different, future focused data to the table allows you to do something that you can't do if you're only looking backward. And that's start planning what you need to do today for where you want to be tomorrow. When we, first brought our forecast to the table, and this was, over a decade ago, and the industry wasn't quite ready to know what to do with it yet. And, our product was in a different place too. So we weren't really ready to help them do something with it. But the important thing was that, looking ahead and setting your goals and not assuming a straight line growth, which is what people would do. Well, if you look at what would have happened if you had done straight line growth from 2020 to 2021 to 2022, it would have been, it is disastrous. And if you look at the more MBA has those really great productivity graphs.
Right.
If you look at that, you can see that it's extremely volatile. So when I'm thinking about one of the problems we solve, one of them is that home ownership gap. The other one is that volatility. It's true that your revenue should go up and down with how the market, that makes sense to me.
Sure.
But if your fixed costs are the same and and revenue is, or income per loan is all over the board, tells me you're not thinking ahead about what's going to happen. So you're reactive. Okay.
Mm.
And so the first thing that we try to do is to say, well, first let's look at what your market is. Let's see what it was and what it will be. Let's see how you did and how you're doing, and find what we call gaps in coverage. So you can start targeting and pinpointing. Once you find a gap in coverage, and when I don't mean like, oh, we have a gap in Texas, I mean we have a gap in the southeast side of Houston. So really digging down to a micro level. When you get that kind of information, then you know how much you have to fill. Like what gaps do you need to fill? Once you do that, that's when you start looking at what I call the 360-degree data. So demographics, real estate agent, and real estate data, data that would inform hiring decisions. So, loan officer performance, lender performance, understanding competition. Then there's the other pieces, which are kind of new and what I think are really critical. Who are the nonprofit partners? Who are the schools? Who are what we call the centers of influence that are part of the critical network for a neighborhood?
Mm.
You start getting all of that data together, and you realize that one strategy, like a one leg strategy isn't going to work. Because let's say, for example, if you decide you have a recruiting problem and you need, let's say, Japanese loan officers, because one of these neighborhoods has a very big Japanese population. Well, you can go out and you can hire a Japanese loan officer, but if you don't have the right product, you don't have the right partners, then that is a wasted hire. And it goes that way with anything. You can have a really great product, a special purpose credit program, and when we're helping people create those and inform those, one of the things we talk about is, what's your execution plan? How do you make sure that your plan and program fit and work? So that's where it all comes together, and that's where we talk about the interconnectedness of the strategy. So it's got to be forward looking, it's got to be dynamic because it's constantly changing. It has to be market driven, so very specific and targeted, and it needs to be what I call collaborative, or built on a network of ideas and people to make it actually work. And so that's what's complicated. There's all these different pieces moving frontwards, backwards, coming from different directions. And yet you have to put them together in a way that allows it to make sense, to not just, you can't think about what loans we can close tomorrow, but you're thinking about, what do I need to do now for my long game? Because with, near mortgage ready, farther out mortgage ready households, you may have a 2 to 3 to 5 year path. The homeowner journey can be 5 years. Well, if you're not touching the household, the potential home buyers at each place, either they fall out and they don't come back into the whole pool,
Sure.
or they go somewhere else. So that's a lose-lose, So we try to encourage our lenders to find ways to stay with their potential customers along the journey, helping them on the journey, holding their hand, even at the very beginning. But that's complicated. And so we hope that, and we think that having the data in a place like with MarketSmart allows them to start making sense of all those pieces.
Yeah, I see your market reports out there. You put some sample market reports out there, and I'm always, gobbling those up, taking them in, and I'm absolutely amazed at the insights that are gained from those when you push out a sample. I forget the market that you did most recently, but I was just like, wow. I mean, this is probably the most important part of our discussion, is you can see the data and you may be able to get another tool that hands you the data, but what do you do with the data? And that's why your partner has to be someone who's not only just a software provider, but is actually advising you and a collaborator with you on your developing a strategy. And the first thing you're saying is, you need to have a long-term perspective to really get the ROI. And I think that kind of goes counterproductive to the culture of our mortgage lending industry, which is, and I was one of these originators, heads down every 30 days. I mean, I took a break at the first or fifth of the month, but after that, I had to start thinking a long month end. So I was on this 30-day treadmill mentally. And a lot of those individuals that became star performers ended up opening their own shops and became their own IMB, or they're running a community bank or credit union mortgage team, and they're still in the same thought process of heads down 30-day treadmill of loan production, because we're measured by our success at the end of every month, not quarterly or annually
Right.
necessarily. So that's a big leap for that's a big challenge for a lot of leaders in our industry. But in order to really have long-term success in this industry, you have to be more heads on the horizon, looking out on the
Yeah.
horizon, saying, what's our long-term growth plan? Let's stop looking down. Let's start looking on the horizon. And that's what but to design that precision-esque, which is what you're providing, like a doctor, a very prescriptive, strategy around long-term growth. They're going to need the data, and then they're going to need the coaching that you're providing with your consulting, and that's probably what differentiates you so much in the market, why you have so many vast clients that are top tier, middle tier, lower tier, because at the end of the day, they have a longer term growth strategy perspective, and you're helping them map that out. It's not going to just happen overnight. Fair lending one, you have to think about fair lending as an opportunity, a paradigm shift. We already talked about that and kind of summarizing our conversation here. But then, secondly, you've got to have the partner that's going to help you, guide you through a long term strategy for consistent year over year, month over month growth, leveraging that fair
Right.
lending opportunity. So, did I summarize that okay?
Perfectly.
I, I,
What one thing that we have been emphasizing lately is, there's a lot of, I do think recruiting is important. But when you have issues with front end loan acquisition costs and you're, getting close to either losing money on every loan or not making much, the absolute worst thing for you as a lender is turnover and
Amen.
hiring and firing. And so I love that we have tools, data that allows people to recruit and market smart. That's important, but that's not a best practice. The best practice is look who you have and figure out how each loan officer that you have now can do one or two more loans every month. And so a lot of what we have on our roadmap, from a feature perspective, is geared toward that. And it's, how can we, at the top for leadership, how do we give them that really, really good predictive and prescriptive look? And then
Mm,
at the loan officer level, how do we show them those gaps in coverage? And how do we make them think outside the box of real estate agents or builders, um, to figure out, or bank households, to figure out how can I continue to grow my business with a market that's constantly changing? If they can do that, not only do they have the added benefit of the revenue and the productivity per LO goes up, but the biggest thing with that is you don't have that terrible cost every time that you lose somebody.
yeah.
I always
200,
say that
it's
if you,
200% right now
yeah,
is your cost.
it
It,
is. It's
it's
terrible. I mean, we did an article, I'm looking at it on the wall right now, in Mortgage Banking Magazine in September of or November of 2015. And at that time, we actually talked to, like, old industry, not old, I don't mean old years, people
no,
from the past who were in positions of leadership, like Tom Gamage. We talked to them and we got all this data back then on how much it cost to lose somebody that you've had for 2 years. That was then, and it was like 250. Um, if you think
wow.
about 30% turnover rate, that is killing the
Oh,
bottom line. Absolutely killing it. And now you have to do the bonuses. You have, so many things go along with this that I don't want people to not recruit. It's great to develop your team, but develop who you have by giving them tools and data first.
wow.
Then if you still can't do it, then maybe they're not the right fit. But don't start with, we need the best loan officer, because everybody's calling the best loan officer.
Amen.
You know?
Wow, that was powerful, Laird. I, um, we covered a lot of ground in a very short period of time, and I think there are a smattering of gold nuggets in the middle of this conversation that you just laid out for our listeners. I can't thank you enough. I feel like we could probably talk another 3 hours. So it makes me
You
look
know it.
forward to having you back in the shark cage so we can keep building on this conversation. But folks, I encourage you, you may need to hit replay on this podcast a couple times to be able to grab hold of all the salient points that Laird brought in your strategy. And at the end of the day, what I hear is, Laird, I don't know if you'll agree with this, but in markets like today, it's never been more important to think smarter, not
Yeah.
harder. A shotgun approach to sales and lending today as a loan officer is no longer going to work, and it's no longer going to be effective. You're going to be
Right.
working harder. Your customer acquisition cost is going to be outrageous. But if you take a more precision-esque approach to it, by backing in and leveraging the data that's out there and a partner like an iEmergent, you're going to have exponential results in your growth, even in a market like this, because you have a partner and you have a tool that's going to break it all down as far as a long-term strategic approach. So I say that okay?
Did perfectly, Keith. You're
Cool.
good at this. I need to take you on the road with me to start being our front man.
Happy to. Be a pleasure. Well, folks, thank you again, Laird. This has been extremely valuable for all our listeners, as I mentioned. Thank you for jumping back into the shark cage with me, Laird. Folks, don't hesitate to learn more about our preferred partner, iEmergent, Laird and her team, and all the things that they're doing for lenders today by checking out their website. Go to www.iemergent.com. Until next time, this has been another exciting episode in the Shark Cage. Have a great day.
Thank you for joining us in the Shark Cage. To be a guest on a future episode, send an email to info@blackfin-group.com. To find out more about the show or the information provided in this episode, visit BlackFin Group online at www.blackfin-group.com.